The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service, Become a Pro course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
Hello and welcome to this episode of Become a Pro course. Evidently, it's the final episode, bonus webinar number 2. We will be discussing and going through a review of some popular methods to trade. Before we do so, please consult the following disclaimer. There is risk inherent trading in the financial markets. And as always, just a few pieces of housekeeping to go through our live interactive webinars. Feel free to ask questions throughout. You can locate your chat box there on the right-hand side of the screen. And this live webinar is being recorded and will be placed into your members area once we have concluded. We will, of course, be hosting an extended Q&A session towards the end of the webinar if you'd like to save your questions until the end and go through some talking points therefore after. Now let's do a quick recap here. Bonus webinar number 2 is today's lesson. Of course, we finished the Become a Pro course there with bonus webinar number 1, a quantitative robustness evaluation of a trading system. Now we're all starting to hopefully think like a professional trader and looking forward to advancing into the markets. Before we do so, we'd like to just deliver this bonus webinar 2 with a quick review over some popular methods to trading. Okay. So what we'll be going through today is a quick introduction to that. We'll be discussing day trading, scalping, swing trading, trend trading, position trading, and of course those technical indicators that we're so fond of trading with. First and foremost, with a quick introduction to some of the most popular ways to trade. It's worth noting, guys, there are many profitable ways to trade the markets, okay? There are many different strategies that you can apply and implement and learn over time, and you can use not only one but a plethora of different strategies. Of course, if you have a preference, say for example, to become a day trader or a scalper, you'll be more frequent in terms of your price action trading. It does not necessarily mean that you'll see a trend develop over a long period of time and use a different strategy for that particular trade, i.e. take a long-term advanced trade, perhaps a carry trade over the Forex markets, over the Japanese yen and Canadian dollar perhaps. So do note that because there are many ways to trade the financial markets and make profit, that they are available to you, and you should learn more and more about each evidential trading strategy. Okay, it is important for every trader to find a style which best suits them. So of course you're going to have a preference for one. Again, as you start to trade the markets more and more and become more familiar with trading the markets, I believe that question will really answer itself in terms of your style, your personal traits as a trader, and your personality with adaptability to approaching the markets. Of course, frequency and the amount of time that you have trading the markets will help answer that question. Again, if you're looking to trade 5 days a week, well, you're going to be more active in the markets. Perhaps you'll be more influenced by scalping, swing trading, and day trading methods. Where if you're looking at position trading, of course, many of our traders simply trade 7, 8, 9, 10 positions over the course of the week. So they're larger in term. Perhaps they stay in those trades for 3, 4, 5 days and simply have more of a structured analysis to them as opposed to looking for small profits like scalping intraday. And of course, trading with indicators, very important in terms of your approach. One point I would like to make, as long as you instill a strong approach to risk management, all of these trading methodologies can be profitable, okay? So before we go through a full bonus lesson of discussing all the different trading strategies, I would like to really reiterate, guys, it's not necessarily the trading strategy that's going to keep you in the game. Yes, it'll allow you to look for opportunities, yes, and hopefully profit. It is your ability to focus on risk management and remain resolute to taking losers and keeping your stop losses in place and focus on protecting capital. Okay, so very important to note. Now let's move into the education, of course. To today's education, of course, we're looking to discuss day trading, and again, involving a very different aspect to short-term trading. Day trading more focuses on trading opportunities that are entered and exited before the end of the trading day. Okay, so particularly you're not wanting to hold a position overnight as a day trader or over the weekend, perhaps. You don't want that stress involved. You perhaps are going to trade with a certain level of position size that will only focus on perhaps a 40 pip winner or a 50 pip winner in an equity or a forex pair, not necessarily looking for longer term structures in the market. So we'll go through this in some detail. Here is a graph in front where we see the US dollar against the Canadian dollar. And of course, what we have inboxed within this area is a lot of volatility, a lot of trading. Effectively from the whole chart, the whole price chart, you can see left to right, it's over a 3-day period or 2 to 3 day period, but effectively within the box here we have a full day's trading. So you can see the amount of opportunity in trading in the short term here, particularly with the 24-hour period in front. Some points to note about day trading here. We have increased trade frequency. So of course, if you're a day trader, you're going to trade more frequently than those longer term investors or traders. You will focus on smaller time frames. As an example, you look at 15-minute price charts, 1-hour price charts, again, focusing on more, I suppose, momentum trades in the short term as opposed to overall journey trades. Now, you can simply see in the price section here as we annotate some possible trading opportunities. This is, of course, broken into the 15-minute candlesticks here. So M15 here with the US dollar CAD simply reflecting the 15-minute candlestick price observation. When we see a candlestick like this here, and I'll just highlight from high to low, the volatility, yet the trend is still continuing. Okay, and then we see the signal next of the next candlestick trade up. Well, that is a sign to us that there's a lot of volatility in this market, and perhaps there's a more higher probability chance of this market continuing to nominal levels to trade to the upside. That could be one trade. Again, in the short term, if you look at the price section, 1, 2, 3, 4, 5, say 6 candlesticks, you could be in this trade for 1 hour and 30 minutes. So it's quite a short trade. Again, you're looking for an appreciative effect of perhaps 30 to 40 to 50 pips. Again, as you see, the volatility changes evidently in this market, and we get a full term trade to the downside again. So you're looking for big moves in the market intraday to look for profit opportunities. Let's just take away that analysis and go through day trading strategy. It is very competitive indeed. And again, your ability to profit over a consistent period of time is going to rely on your ability to read short-term price action in a competitive nature. And of course, you're more open to that intraday volatility. Okay, given the fact you are, of course, focused on the short-term trade. I'll choose one example here. Again, we'll look to trade this price chart in front. Let's say we believe this market is going up and we enter at these prices here. Well, then we see a lot of volatility here, and then over the course of the trading day, it actually trades up very strongly, but then pulls back and then moves to all-time lows, okay, during the trading period, and of course closes just a little under where you are during the course of the trading day. So you're actually going to have a lot more sentiment, a lot more feeling for this trade, a lot more emotion in this trade in terms of that volatility that will test your patience. So to be aware as a day trader, you're going to be able to, hopefully you're going to be able to counteract that with trading strategy and style. So what I would like to do then is just move across to our trading platform, MT4JFX trading platform, and look at this style in much more detail. Okay, so we'll open up and consult our platform. The first market we have open here is the Euro US dollar. How would we perhaps look to trade this intraday with day trading methods? Well, we're looking at the daily price action as well. We can simply say, well, over the last 2 days, how is the market trading? Okay, well, we know that we're in a downwards trend here, but we've seen a bit of a bounce across this market relatively soon or recently. Then we get the retracement candle here, and now it's bearish on the day with candlestick 2. So what we look to do as a day trader is simply gather or attempt to gather a few pips in this momentum. Okay, so perhaps we'd like to zoom in and observe shorter term price action. So let's say we zoom in to the 30-minute price action chart. Again, it looks to be weak over shorter term price action. Again, that's simply what we can see. We can see this market trading down in the last relatively day. And again, there's a bit of volatility here just to show that we might be able to capture some pips. If we break these levels, perhaps we don't want to be in the trade. So what we could simply look to do is sell this market at price now, which we can do on screen, of course, just as a method of practice. we'll simply sell this market here. So we're now short the market, and our profit opportunity could be in around nominal prices here, just to try and capture some momentum to the downside. So that's perhaps a 20 pip winner or a 15 pip winner to downside, just to capture a dollar here or a dollar there. Again, this is just trading very small trade size. And again, if we remove our annotation here, let's just say we don't want to be in this market if we break these highs. Well, effectively, we're running a 2-to-1 risk reward on the trade. And the stop loss here evidently is $1.14, and we're looking for, let me see, a $2.05 winner. So just one method of actually looking at a day trade, breaking the candlestick structure of that particular trading day. We know it's weak across the day if we zoom out on the candlestick again. And we're looking for it not to break new lows of the day, but just to come back down to where it was, albeit a few hours ago. Okay, so that's just a day trade. Perhaps we're looking at the term of this trade within the next 2 hours. And if we're not, at full profit potential in around the next 3 hours before the market closes, of course, we can simply look to take profit. And just for purposes of discussion, we'll look to take profit on the trade now. Again, we'll just go in to our order, and as this market trades, you can see the profit potential here. We're trying to capture some pips throughout the course of the day. So let's just close that trade now, as a result of just showing you how to place an intraday trade. Let's move forward with our trading strategies. One of the most popular trading strategies is, of course, scalping. Okay, scalping, and it's more frequent in terms of its time frames. You're going to look at trading 1 minute, 5 minute price action charts. It's very, very active. It's a very active style of trading, and it involves those opportunities that specialize in taking profits on small price changes, normally soon after the trade has become profitable. Although you do, of course, try and run your winners and cut your losers short. So a couple of points to note about scalping. It does have extreme trade frequency, okay? If you're looking to scalp the markets, you will particularly look to, capture 20 pips here in one market, 30 pips here, perhaps 10 pip loser there, 15 pip winner there. So you're trying to grow your pips through a process of active trading. You're looking at small time frames, again, perhaps 1 minute, 5 minute price charts, 10 minute or 15 minute price charts. You can experience, of course, extreme volatility. Of course, scalping is often the best approach when you see a large shock to the markets. Let's say there's a shock in the oil market. Perhaps you're scalping the oil figure itself, released every Wednesday, mostly every Wednesday, sometimes on a Thursday at 1:30 UK time. Of course, if you're looking to trade non-farm payrolls and simply scalp that market, you don't have an overall view to the market, but you know there's going to be volatility. Volatility is the scalper's friend. So you're just looking to gather and collect pips throughout the momentum. Discipline is an absolute necessity, of course, because it's completely discretionary. So you enter the trade via market execution. You're looking to scalp in and out of the markets as the volatility trades up. And you can see with this price chart here, as the market moves from left to right, there's so many different opportunities. Again, you're not trying to buy the lows and sell the highs. That would be more in tandem with swing trading. You're looking to actually just get in, followed with short pip movements. Again, looking to sell the market down. If it reverses, you take profit here. You look to buy the market again if breaks. And again, if it reverses, you look to take profit. You'll take some losers in there. It's active trading. But guys, if you have the skill set to read volatility, you can be a very, very profitable trader as a result to scalping opportunities. So let's jump back into our JFX trading platform and look at this style in more detail. Okay, so what we have on screen here, if we move across other markets, what we would choose today, the US oil market, again, we'll look to zoom in on 5 minute price charts. And again, we can see there's been a significant move in this market. So this is a perfect example to actually look to make quick profits as these markets move in relation to volatility. So here you see the market just ticking up. Okay, just ticking up with a little trend here in very short-term 5 minute price action, but then we get a signal to actually look to capture news. As you see, this market trades down quite rapidly again, albeit it's only 25 ticks, but in relation to the other candlesticks, that's quite a large move. And then you could look for selling opportunities again, just to try and follow momentum down. So you may sell the market here and hold that for perhaps 10 minutes. So that's a 5 minute candlestick, and then this 5 minute candlestick here shows us that the market does not want to move, and you may look to simply take profit at these levels. So again, given there's no real volatility in the move here, When volatility enters the market, you're looking to speculate, you're looking to get actively involved in volatility trading opportunities and look to capture a few pips. And again, if we sell this in around 65 to around our 30 mark here, that's a 35 pip winner. Okay, so we've just caught 35 pips in that trade if we make the trade. Okay, now of course you can run many different risk reward trades on the market here. Of course, if you're looking to simply capture a 35 pip move, you could look for 15 pip stop losses here, anywhere around. But do be aware that you're going to be actively involved in that volatility, and you're going to see markets trade up, move against you in the short term. And you need to accompany an added level of, I suppose, stability in terms of your emotions to actually appreciate how volatility can move the markets and shake the markets and shake traders in and out of the markets. And you have to obviously remain resolute to your trading strategy in terms of that discretion that's involved in scalping. Let's look at another opportunity here in terms of scalping. We can zoom in. Here's the UK FTSE. Let's say we have the close coming up. Again, what time are we looking at on the price action chart? We could say we have the close coming up and it's been a very strong week in the equity markets. Let's say we're looking for a simple 20 pip winner in this market. We could look to simply place a new order, sell the market in the FTSE at this price as it looks like it's moving down. And as the market continues to trade, let's zoom in on price action again. We can see that it's a slightly weak, and as this market looks to trade, it's just soft. Okay, we could place our stop loss above the last corrective high. And again, as the market trades, we'll just say, okay, we're looking for a few pips here. We're 2 pips on sides, just moving down, and we'll just take profit there as the market trades. So simple, getting in and out of the markets, making a few pips here, of course, making 10 pips, 20 pips here, trying to keep your discretion very tight in terms of your stop loss appeal. Let's look at another very popular method of swing trading. Swing trading inevitably is what it says. It's focusing on the large price swings intraday over a set period of time. Okay, that's what we're looking to do. Trading opportunities aim to profit between medium to large price swings as a result of that intraday volatility. So effectively, what you're looking to do is assess price movement, okay, assess the level of sentiment and volatility in the market, and look for opportunities. So again, we'll consult our price action screen here to the left, okay. When there's a move like this, we'll simply judge the price action candlesticks, 1, 2, 3, and as the market starts to trade up, we'll maybe try and buy this candlestick here. Okay, so we buy that candlestick as a swing, it's moved down, and as the market trades up, once we see a level of rejection, say this, we'll look to exit that market, say here. So we've caught a large part of the swing trade here. Then we look for another opportunity. Perhaps we can see a little bit of a trend forming here to the upside. But as that breaks here, we'll sell this candle here and then look to take profit as it reverses. So say here in around. Again, this is totally hypothetical, but this is a very effective trading strategy. Again, you can start to see, as this market moves up again to nominal areas, you have many different opportunities to look to make the same trades in a short period of time. Again, if you're looking to buy the lows, you'll say, well, I'm looking for rejection periods here. Perhaps I missed this one. Okay, I've missed this one for whatever reason. And then if the market trades down here, I'll try and capture this one. Now, I'm not trying to say that we'll buy the low and follow it the whole way to new highs. But again, if you're trading markets, guys, what we say in professional trading circles is if you're able to capture half of the move in any trade that you make in terms of the move, the size of the move, then it's a good trade. So if you were to buy the market here and exit here for a winner, that's a good trade. Again, you've just made a similar trade here at A. You've got lower lows across here. When this market trades down here and you get a rejection signal here, just as good trade, guys. Try and get involved there and look for profit potentials in around the same area. So plenty of different trading opportunities as a swing trader. You're looking at frequent trading. It is discretionary in nature. And again, you can experience extreme volatility. We can see with this price action chart quite a bit of volatility. So let's discuss this in a little more detail in terms of observing price action, okay? Let's bring up our JFX trading platform, and we'll use a couple of markets here to describe how we can enter and exit these profit opportunities, okay? Now we're looking at daily price action. Let's try and break this down. What's happening in the FTSE? What's really happening in the FTSE this week? How many trades could we get off in the FTSE 100 this week? Okay. So if we were to zoom in again on the price action, this is what we're seeing over, let me see, the 8th to the 5th. So I'll just highlight that on screen here, okay? Just observe the dates at the bottom. We have the 5th of June and then the 8th of June here. So we have 3 days of price action, okay? We can forego what's actually happening in the daily price action, just simply trying to read what's going on. And again, there's selling opportunities here coming from highs. So that could be one. That could be our trade A. Perhaps we look to break these little lows and we sell this candlestick here. That's our signal. Perhaps we sell the low here and we wait for the confirmation and forego the actual trade. So I'll actually take some analysis off here. And we'll choose this candlestick here to sell. Okay, right here again, this is after the fact, but this is how you can effectively use a trading strategy, okay? Swing trade entry right here. We observe this candlestick and our stop loss could be up just above these levels here. So we don't believe this candlestick is going to retrace when we place our stop loss there. Again, there's going to be a little volatility in the swing. We know that, okay? There's volatility in the swing here, here, and as the market shows us profit again, it actually pulls back in the 30 minutes, okay? But then the market trades down. And again, once that volatility stops, it trades down to these levels here, shows us a little area of consolidation, and effectively, we can take profit here. Okay, we take profit there. Now, as the market opens up again, it looks to reject these highs. We may look to actually break nominal levels again, and we look to sell this candlestick here. So again, we use the same formula. We look to try and capture some pips here. We sell at this market here. So we literally sell. That's our entry price there. And then we place our stop loss up here perhaps. And then we try and capture some momentum to the downside. Again, we're very unlikely to get out at the low. But of course, if you're able to capture some of this potential here, that's a good trade. Now, what's going to happen in this market if you're observing this market and you've traded it profitably twice? Or maybe you traded it profitably once and you missed the second trade, that's absolutely fine. You're always looking for swing examples, if you're a swing trader, to get involved in opportunity again. So when this market trades up to new highs, you're wondering, is it going to trade up to new highs, i.e. break these levels here? Or is there going to be another swing to the downside? And again, you can simply look at the price action to look for clues. So here is our worrying sign that perhaps this market is strong, but evidently it looks to retrace off the second candlestick. So we get that signal. We then get our indecision signal there. And finally, we get our candlestick here for our entry to tell us that we can maybe try and sell this market right here. Why? Because we're following another swing. Let's look at the structure of this swing here. Okay, we have 1, 2. Evidently, you could have traded this swing to the upside, but if you have a directional bias in the market, you're preferring to choose one direction. Of course, you can do that. But right here, you're asking yourself some questions. You're asking yourself some questions where this market is going in terms of a swing trading opportunity. And you're only going to trade the price action. If it trades to the upside like this, well, then you forego that opportunity. Perhaps you don't want to be long that trade. But effectively, we get the sell right here at this candlestick. We could choose to place your stop loss right here with your stop loss 1. And again, you can see as the market continues to weaken, it shows you profit. That's a fantastic trade to the downside. Again, if you're able to actually capture some of this momentum, you may look to move your stop loss as it goes down, continues to go down, and you may have got stopped out at this candlestick here. So you've taken an involuntary take profit, but that's fine. You've captured 79 to around 57, so say around 30 pips there. Okay, so that's a great trade. That's maybe 25 pips, so that's a good trade in terms of allowing yourself the opportunity. And then right here, as we come back into question time, you're trying to follow more swings. Is this an opportunity for me as a swing trader? Is this evidently another swing where we follow this wave and then it looks to reverse? Look at the structure of these Japanese candlesticks in the 30-minute price chart. We get 1, 2, 3, 4 signs that the market does not want to trade. Perhaps that's another trade to look to sell here. Okay, and we place our stop loss perhaps above nominal levels. Again, looking for profit potential here. That's perhaps a 2-to-1 risk reward trade. Again, simple trading strategy, very effective when used. I would say across different asset classes, because markets traditionally, they don't trade in a linear fashion. They trade, of course, according to large variances of volatility across different markets, of course, and they'll trade in this zigzag fashion. If you're familiar with technical analysis as well, we relate a lot of that to Elliott wave theory, where markets will trade in a zigzag or this sort of high and low fashion. And it's simply looking for the best technical opportunities. Again, if you're simply looking and observing the price action here with the daily candlesticks, well, it doesn't give you the same swing trade setup in terms of observing the candlesticks that the shorter time periods do. Now, there is room for discussion that swing trading does allow, of course, traders to get involved just in the overall consolidation level at that daily level. So you look to sell these highs, perhaps fade these highs if you believe the market's weak, and to take profit in around nominal levels. That's another method as well, but it is focused on observation and to closer dated and shorter time frames swing trading strategy. Again, we look to use it off a forex pair. The oil market, again, this looks to trade up to the upside, so that might be another swing trade. Again, the market's traded down, it's weak, that now reverses. Again, you might look to capture this swing to the upside, so you'll enter at this price. Let's just use some analysis here. You could enter at this price here, and then place your stop loss perhaps around the last corrective low around here. Again, looking for a resurgence of the trend. Just a thought, but you're following to trade the swing in price action A, taking advantage of this short-term volatility. And again, we don't know what actually happened in this market here that caused this little break. All we can say that, well, is there an opportunity in terms of trying to fade this move? Is there an opportunity in trying to follow this new momentum to the upside? Again, given that we've given it the chance to trade, and it looks to trade a little stronger to the upside again. You might just be looking for 20 pips here in terms of a full day trade as well. So it's always relative to the term of your trade.